Okay, so imagine this. It's a totally normal day on Wall Street. No big news, no major banks are failing, absolutely no reason for anybody to panic. And yet, in just a handful of minutes, the entire global financial market just breaks. That's not a hypothetical. That is exactly what happened on May 6, 2010. And this is the story of the flash crash.
So at 2:42 in the afternoon, the market's a little jumpy, sure, but it's stable. And then literally in the blink of an eye, nearly $1 trillion in market value just evaporates, gone. To put that in perspective for you, that's like the entire economy of a country like Australia, just poof, wiped off the map.
And here's the part that is just truly mind-bending, the speed of it all. This entire collapse and the recovery, it all happened in just 36 minutes. $1 trillion vanished, and then it just reappeared, leaving every single trader and regulator on the planet completely speechless.
I mean, just look at this chart. It shows you the sheer cliff dive the market took. The Dow Jones dropped almost 1,000 points in minutes, and there was no good reason for it. This was just pure, raw, algorithmic chaos. For those 36 minutes, it was like the machines were at war with each other, and the entire global financial system was their battlefield.
This chaos led to some of the most bizarre things you'll ever see. You have these huge, stable, blue-chip companies like Procter & Gamble just getting completely decimated. Accenture, a global consulting giant, was trading for a single penny. A penny! Nothing made any sense. It was as if the basic laws of finance had just been switched off, and it left everyone staring at their screens asking one very simple question.
Right? What just happened? That was the question on everybody's mind. Was this a hack? Some kind of crazy computer glitch? Or did somebody make a colossal, career-ending mistake? The race to find an answer started immediately. Because, let's be honest, if something like this could happen once, it could absolutely happen again.
So in the immediate aftermath, you have regulators just scrambling, trying to piece together the chain of events. A whole bunch of theories started popping up almost instantly, as you'd expect, with everyone trying to pin the blame on a single, easy-to-understand cause.
At first, the headlines all pointed to a fat finger error. Somebody accidentally typing in a few extra zeros on a trade. Simple mistake. Others blamed the high-frequency trading algorithms, or HFTs, these bots that use supercomputers to make millions of trades in seconds. Technical glitches were, of course, a big suspect. And yeah, investigators did find one huge, totally legitimate sell order from a mutual fund that kind of acted like a spark. But here's the thing, none of these theories, not even all of them together, could really explain the sheer scale of the collapse. The mystery was only getting deeper.
The investigation took years, and when the answer finally came out, it wasn't some Wall Street giant or a rogue, super advanced AI. Nope, it was something so much more unexpected. It was a true ghost in the machine.
So get this, 5 years after the crash, U.S. authorities arrest a guy named Avinder Singh Saraw. He wasn't some hotshot hedge fund manager or a bank executive. He was a lone futures trader, working from his childhood bedroom in a London suburb, thousands of miles away from Wall Street. And somehow, he'd figured out a way to trick all the machines.
The method Saraw used is called spoofing. Basically, it's a market manipulation trick where you place these huge orders that you have absolutely no intention of ever actually filling. The whole point is to create this fake illusion of supply or demand, which then tricks other traders, especially the automated ones, into reacting to market conditions that aren't even real.
His whole process was like a 4-step dance with the algorithms. First, he'd put in these massive, totally fake sell orders. The trading bots would see this giant wall of selling pressure and automatically start to panic sell. As the prices started to fall, Saraw would quietly step in and buy up contracts at the new low price. Then, right before his fake orders were about to be filled, he'd just cancel them, and he'd profit as the market bounced back. It was brilliant, in a way.
And the scale of what he was doing was just staggering. On the day of the flash crash, investigators found that at certain points, Saraw's fake orders made up over 20% of all the visible sell orders in that key futures market. Think about that. One guy, in his bedroom, was single-handedly creating enormous, totally artificial selling pressure across the market.
But, and this is the crucial twist in the story, even the prosecutors admitted that Saraw wasn't the sole cause of the flash crash. His actions were the spark that lit the fuse for sure, but the real culprit? That was the explosive material itself, a financial system that had become so fast, so automated, that it was fundamentally, dangerously fragile.
Both academic studies and regulatory reports pretty much confirmed it. The high-frequency trading bots didn't start the fire, but man, did they pour gasoline all over it. See, when Saraw was spoofing and that other big sell order hit the market, the HFTs reacted by not just selling like crazy, but also by pulling all their own buy orders out of the market. And that's what's called vanishing liquidity. All of a sudden, there were almost no buyers left, which turned a small dip into an absolute freefall.
So you've really got two different sets of factors here. On one side, you have the triggers, Saraw's manipulation and that one large sell order. But on the other side, you have the real underlying causes. A market structure that was just too fragile, these dangerous feedback loops between the algorithms, and liquidity that could just disappear in a heartbeat.
This is what's known as an algorithmic cascade, and it is a terrifying feedback loop. One algorithm sells, a second one sees that sale and sells even faster. A third one sees both of them and sells faster still. Within microseconds, a little ripple becomes a tsunami. The critical thing to understand here is that the machines aren't reacting to news anymore, they're just reacting to each other. And on May 6th, they created a self-reinforcing death spiral.
The flash crash was a massive wake-up call for everyone. It exposed these really deep flaws in the whole architecture of modern markets. So in the years that followed, regulators scrambled to build in some safeguards to prevent another meltdown. But the big question is, are they enough?
So the two main U.S. financial regulators, the SEC and the CFTC, they launched this massive joint investigation. And what they found led to a whole wave of new rules, all designed to build some much-needed guardrails into the system.
This led to a few key reforms. First off, spoofing was made explicitly illegal. Duh. They also brought in new circuit breakers that can automatically pause trading in a stock if its price goes haywire too quickly. The market-wide halts were also strengthened. And finally, a new audit system was built to give regulators this kind of God's eye view of the market so they can trace events like this in real time instead of 5 years later.
So, with all these new protections in place, are we safe? Has the problem actually been solved? Well, the answer is, it's complicated. Because the technology at the very heart of the market, it hasn't exactly been standing still. Look, the algorithms back in 2010 were fast. Yeah, but they were actually pretty simple. Today's markets are increasingly driven by true artificial intelligence, really complex self-learning models. And these systems often operate as black boxes, which means their internal logic is so complicated that even the engineers who built them can't fully explain why they make certain decisions.
And just to understand the scale of what we're talking about here, look at just one system, BlackRock's Aladdin. It's an AI-powered platform that oversees more than $21 trillion in assets. That is roughly 10% of the world's total financial assets, all being influenced by a single piece of software. I mean, what happens if a system that powerful makes a mistake?
And that brings us to the final, and frankly pretty unsettling question. The algorithms in 2010 operated in milliseconds. Today's AI operates in microseconds. The safeguards we built, like the circuit breakers, they were designed for a 36-minute problem. So what happens when the next crash takes only 36 seconds? The flash crash showed us the incredible danger of giving machines control. And since then, we've given them even more control and made them exponentially faster. This is not financial advice.